You clicked on this video because you saw boring, 6 figures, and you want the secret. And shit, that's why I'm here. I'm gonna give you all the secret. Wrong. The secret is that there is no secret, and the longer that you think there's a secret, the longer it hinders your process to actually get to where you wanna go. But I know a lot about trading, so I'm gonna teach you the ways that I know how to get there through a mechanical, repeatable process that can remove emotion and make you a lot of money. My name's Dylan. I've been trading for around 4 years, and I have nothing to sell you. So like it says right here, this is going to be an intermediate to advanced level content, trading content. I went over the entry level mechanisms to, as you can see right here, in my last video. So this is embedded. You can just click that, or well, you can't click it. I can. But go watch the last one if you want lower level concepts. Like I said, these are going to be a little bit more, not too advanced, but more advanced than entry level things. So what we're going to be going over is gap fills, more market structure, accumulation and what that means, manipulation in psych levels, entry strategy, and exit strategy, more in depth. And like my little disclaimer there at the bottom says, this strategy is really boring, forces you to wait, it tests your patience, but patience in this game is the only thing that pays. All I'm teaching in this video is how you can pretty much pour kerosene on the fire of your learning curve, meaning how can you speed up your learning curve. Okay, first of all, we're gonna go over gap fills. Now, I trade gap fills in 2 different ways. I'm gonna go all the way at the bottom here. I either determine a gap fill as an undervalue or an overvalue of a stock / a pair, or I use gaps as openings that are based off key levels so I can get an entry. Pretty much what gaps are liquidity vacuums where price moves so fast that there were no trades executed, creating an imbalance. The market, like a magnet, is always trying to rebalance itself. Now, how do we apply this, right? What does that actually mean? Now, if we look on ES here, this is pretty much the S&P 500, but it's the futures contract side of it. You see, a couple Mondays ago, we opened with a gap in the market that created an imbalance. And now, since this wasn't really a crazy gap and it's just a weekend opening gap, I would consider this as a way for the market to rebalance itself and not as, like we said, an overvalue or an undervalue. An undervalue or an overvalue, obviously depending on which direction price goes, is when it gaps up, or like I said, below, is when your bias of the stock or the pair or whatever you're trading is worth more than it should be based on the catalyst for that gap. Pretty much like we talked about in the last video, effort versus result. If you think that the price of something is extremely overextended and gapped up, then you can use that overvalue / undervalue to your advantage, because they can then revisit or break over key levels so that you can then get a bias on a trade. And now, like we see here, weekend gaps are a little bit different. These are more common, so I'm gonna go over this. But this, in my opinion, is one of those things that you have to have in your tool belt at the start, because it shows you that the market that you're trading is mechanical and not random. But also, we want to operate in if and then sequences when we're trading. So the market opens in this gap, or I guess it creates the gap when it opens. So we think and we hope that it will revisit at some point. Once we make structure and then we actually do revisit, we then create another gap. Now, the next week we open below it and we respect it again. And so when I say gaps are mechanical, this tells us that this area from here to there, and what happens when we have an area of interest that is extremely respected, we can then use our strategy and wait for market structure to push up into the area, wait for the area of interest catalyst, and then base an entry off of that. So pretty much the idea of how I trade this version of a gap is just another way to gain an area of interest with extreme confirmation. Okay, the next one is market structure / price analysis / accumulation and distribution. Market structure and like VPA, volume price analysis, I kind of put them under the same umbrella, and then accumulation and distribution are a little bit different. But like I said, my entire strategy is based off of market structure. I start by looking at the daily and the 4-hour, and I figure out, okay, what is the market giving me, right? What do I know so that I don't have to use if and then statements? I can use what I know right now. So if you can see here on this graph, there's the high, you can't really see it, that little circle up there is the high. And then we have the relevant lower low, we have the relevant lower high off of that high. We have the bearish engulfing, and then we have the relative lower low, relative lower high. So we are in a bearish market is pretty much what that means. So I can then use this structure, also these lower highs, these are lower high, to then get a bias on my trade direction. Pretty simple, that's beginner level. All right, back in trading view here, if you can see, you can believe me or not, I don't know if I can even prove this. No, it doesn't, I don't know, believe me, whatever. I made that like last week, today's Friday, made that last week or the beginning of this week to make for this video. And as we can see, it worked, right? You would have caught a big trade. But why did I didn't just use this random example. This is a good idea of distribution and how it works. So distribution in this example is pretty much large sellers selling their position, and it's often at the end of a prolonged uptrend and like a failed buying climax. And what is this? Here on both time frames is what I would consider a failed buying climax. We have an overextension on the lower time, or the 4 hour here. And then we have these, let me get there we go. And then we have higher lows followed by higher low, and then we have higher highs followed by higher highs. Now, what do we have after this high, this buying climax failed high? We have price ripping through this range. And now I could tell that this was going to happen based off the general structure of this right here. I guess you could use a trend line here. And also the spread of these candles and how condensed it looks. And now, what do I mean by the spread of these candles? Well, the spread of these candles aren't very large. There's no engulfings, there's no really anything here. It's just price consolidating, and it's what this means is that the bid and ask of this USD CHF, of this pair, is getting super tight, and the spread, nobody can really win the battle here. So we're kind of following in this channel, and once I see the buying climax, if we zoom out, it's the same thing on the daily. And once I see that buying climax is probably going to get torched, meaning buyers are gonna get torched, they're giving up their position. I then wanna wait for the confirmation of this channel break, which would be the lower trend line right here, and then base my area of interest off of a previous supported level. And now I just said supported, but it can really be any area of interest that's respected. But really how we just use distribution is any increase of selling pressure off of a buying climax. We know that that can signal distribution and overall the bias of the direction that we want to head, because this right here is a divergence of momentum. Next thing is the sweeps that really follow after any accumulation or distribution, which is why it's the module right after this. And we actually just looked at an example, but I'm gonna teach in a little bit more depth about the setup, the sweep, and then the signal. So I learned actually how to trade based off the methodology of the Wyckoff logic. The book I read was the Wyckoff methodology. It's like a black book with charts on it. Good book. It's probably the only book. That and Trading in the Zone are two good books I think you should read if you're into trading. But this does a really good, this is actually a picture that was in the book, I remember this. This does a really good visual representation of how I like to look at the markets. So like we just looked at, we can have our buying climax followed by that like sharp falling knife pattern. Or sometimes what we can have is a buying climax, but then it's followed by consolidation for then another failed rally, and then we get our break and retest and that falling knife. And so pretty much what Richard Wyckoff is saying in this book is that once we fail below this, and this is what he's saying right here, is the break the ice. That is just a bearish engulfing below your area that is previously respected through your consolidation. Once we break the ice, we then push back up into our area of interest on a low volume rally. Now, I want everybody to be very conscious of volume and how they use it, because especially with Forex pairs, volume can be there can be a lot of anomalies. What do I mean by that? But ultimately, the way I navigate around sitting in consolidation is we have two parts here, right? We have the break the ice, and then we have another structure point created, meaning I have my relevant lower high created back into the structure. And then we have another bearish engulfing, so another break the ice. So I have pretty much a two-step plan when distribution breaks. You might be sitting there thinking, oh, that's simple. Like all you have to do is wait for two things to happen. And you're exactly right. It's really easy. You just have to have the patience, because if we're looking at this is a 4-hour candle. If I were to get in on the first break of this channel trend line and my break the ice, I might have gotten stopped out, because I could have entered here, put my stop loss right here, and then I wouldn't have gotten stopped out. But let's say I put my stop loss here, would have gotten stopped out. So I like to wait for a 2-step confirmation so that I know for a fact that it's under my previous respected structure point. And we're also creating these diminishing lower lows inside of another channel. And now I was kind of yapping about the same accumulation model or distribution model that I was in the last step, but this is a better example of how I use sweeps, like actual sweeps, to get my entry, which is gonna be the next part. Pretty much I'm breaking down the same thing here. Is we have our high, we then have our lower high, and then our equal high, which is like, I'm saying equal based off of the lower high, obviously not this high. We have an equal high here, and then we have a sweep. And you might be sitting there thinking, oh, how is that a sweep? It closed above it, right? These 2 candles closed above. And you'd be right, but these wicks also went above it, and we didn't close above it. When we get a formation, I don't know, I was gonna say formulation. When we get a formation like this, where it's 2 candles, and obviously you'd have to wait. So this is why we don't enter prematurely. You wouldn't wanna enter on this anyways, like who in their right mind would enter on this? Once we have this super bullish momentum, and then we have these 2 wicks like this, we then have a tweezer top. These 2 candles, when they are closed identically like this, the bodies are closed like this at the highs, that is called tweezer tops. And now, I'm not saying that it's 100% success rate, that when we get a sweep and a tweezer top followed after a climax, and then, like I said, the lower high with the equal, and then we have the sweep and the tweezer top. I'm not saying it's a successful, or it's always going to be a successful thing. And honestly, I don't even know what this is going to do after this. I'm showing you this in real time. But for the sake of the video and for the sake of sweeps, that is what I would consider a sweep. I also made a little Instagram video that I put out. It's kind of about this whole module I'm talking about. It kind of puts everything to one. It talks about the sweep, manipulation, all that good stuff. All right, bringing everything back together here. How do I know when to enter? And so I use these 5 things right here as 20% markers for a 100% trade. So like we went over, I have my market structure. I make sure it doesn't say on here, the hourly, the 4-hour, and the daily are heading the direction, or at least heading in the direction that I want to. We have our accumulation, which is another 20% accumulation / distribution based on the direction. We have a sweep at some level. It's kind of trickier with Forex because it's a lot of a choppier chart pattern, but we wait for some manipulation or a sweep between a low or a high of a range, and these should be switched. Candle formation, like I just talked about, tweezer tops are a good one, doji candles, and then bullish and bearish engulfings are always going to be your best friend. That's going to be through those levels, or you're always going to want to look for engulfings, or like Wyckoff calls them, break the ice, which then leads you into your entry confirmation, where you drop to the 15-minute. I don't use the 5 chart. I don't know what's on there. It should say the 15 or the 30-minute chart, and then you wait for a lower time frame confirmation of a shift of structure. And that's the easy part. You see all these like day traders that like trade on like the 1 minute, and they really have no like bias or direction, or like have any patience, and they've never looked at a 4-hour chart in their life. And I'm like, that's where you figure out the good stuff. That's how you know where the overall like macro trend is going. So how can you make an educated decision on the lower time frames if you can't even properly analyze the higher time frames? So like I said, that's just how you get your 15, 30-minute market structure shift. That's just how you get your entry. I went over that in the last video. I also kind of went over it in this video, but yeah. All right, the last thing is the exit strategy. How do you get out of a trade? I have people come to me all the time. They're like, okay, I can get an entry now, but I'm getting burned on getting out of the trade. I don't know when to get out. That's my hardest bottleneck in my trading. Now, it's one of 2 things. You either are really greedy and you try to go for those like 1 to 10 RR setups all the time, or you actually just don't know where to base. Like fundamentally, you don't know where liquidity sits for you to get out and still get like a pretty decent high RR. And now this ties back into, you see my strategy all is pretty much under one umbrella. This ties back into accumulation, and distribution. And so most of the time we are going to want to target the opposite side of the set range. So like if we go back into this, I'll just keep using this as an example. Let's say we got our entry where I said we wanted to this Monday, right? We got to trade on this Monday somewhere when we push back up into here on low volume into this area of interest. You can't see it because I'm only hourly. But we got an entry here. How would I have entered this and where would I put my stop? Well, if we zoom out here, we can see that the last bit of accumulation was down here. We have market makers continuing to accumulate, which is why it's called accumulation, accumulate a bigger buying position on these lows. So this low is a snipe, 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 push up. So that means that the opposition of liquidity is somewhere below these accumulation ranges. And like I have here, pro tip, put your take profit a little below or above, depending on direction, your area of accumulation or distribution that you're targeting. So in this example, our accumulation lows are down here. You could say here, here, here. I would have put my take profit here because that gives me, I can sleep at night knowing that it's not below those ranges because that's being really greedy. That's being really risky. And if we enter up here and it's still on our second phase, it follows our entry, meaning our second phase of distribution buying. If we enter up here, then that means that you should have no problem with taking this, putting your stop loss somewhere here if you're a baby up here. No, I'm kidding. But you can do that. That's still, I mean, look at this. That's still a 5-to-1 trade, and that's if you're greedy, or that's if you're passive, sorry. If you're passive and you go down here, that's a 5-to-1. That is the beauty of swing trading. You could have put $200 in this and made $1,000 profit. So yeah, that's how I would calculate my take profit. It's really not that hard. Just don't really target the bottom ranges of accumulation. And if you're a 1 to 2 trader, you constantly try to hit 1 to 2s, you could have put it at the low of this. I mean, that's not accumulation ranges, but that's just a wick that we have, right? That's our relative lower low based off this relative lower high. Or, and this is the more passive model, you can use the next leg of a fair value gap. Meaning this right here, I'm gonna pull it down, this right here is an unfilled fair value gap. So you look for these ranges of price that are pretty much unfilled and you target the middle, meaning somewhere around here, and you could have put your take profit somewhere there. I mean, those are all three, in my opinion, really good ways to calculate your take profit. Also, another really good tip is always define your take profit before you enter a trade, because when you don't do that, it turns into chaos. It also removes your emotion and you turn into a sniper. Pretty much what that means is when, let's say you go to the casino and you're playing roulette, the odds are not in your favor, but when you play something like blackjack, you are hitting and standing. You are making the conscious decision to do this or this before the result of that action. And that's just another way to take your risk into your own hands and determine something before the outcome actually happens. Then you can take accountability for what you've done, whether you win or you lose. Thank you for watching this video. We went over gap fills, market structure, accumulation / distribution, sweeps, which is manipulation, and then entry and exit again. I went over a lot of these things in the last video as well, just this was a kind of higher level video. But yeah, trading becomes boring once you remove the gambling. It's supposed to be boring. When you start trading boring, that is when you feel like you're actually moving the needle. You feel like you're actually doing something. You become like I said here, it's corny, but sniper, not a machine gunner. If you want the AI trading PDF, if you're following on my Instagram, if you want that AI trading PDF where I teach you how to use second order thinking to not be commoditized in the markets, I'll put it down below. And then tell your mom, grandma, tell everyone to subscribe, and peace.